In this lesson, I'm going to cover gamma. Before we learn gamma, let's quickly recap delta. The key definitions of delta. Delta and price sensitivity. Delta measures an option's sensitivity to changes in the price of the underlying asset. It indicates how much an option's price moves for every $1 change in the underlying asset or stock price. Probability estimator. Delta is also known as a rough estimator of the probability that an option will expire in the money. A delta of 0.25 suggests a roughly 25% chance that the option will expire in the money. So what is gamma? Gamma is a second order Greek behind delta. And second order means it's a derivative of a derivative. It is the derivative of delta. If delta, a symbol that represents a change in the options price to stock movements, gamma represents how quickly or slowly that change happens. Textbook gamma definition. So gamma measures the rate of change of an option's delta in response to a $1 change in the underlying stock's price. In essence, gamma is the acceleration of the option's price movement. If delta tells you how much the option price will move, gamma tells you how much delta itself will change with a move in the underlying asset. A higher gamma means a higher change in delta, which indicates a higher movement in the option's value when the stock moves $1, all else being equal. Stability indicator of delta. If you think of delta as a probability estimator, the likelihood of being in the money at expiration, gamma can be used to assess the stability or instability of that estimate. A higher gamma is an indication of a greater potential change in delta, which equates to an instability of delta. A lower gamma is an indication of a lower potential change in delta, which equates to more delta stability. Key characteristics. The value is positive for both calls and puts, unlike delta, which can be positive or negative depending on the type of option, a call or a put. Gamma is always positive for both calls and puts. Gamma is highest for at-the-money options because these are where the smallest change in the underlying price will have the most significant impact on the delta. As options move deeper in or out of the money, gamma decreases. Gamma in time to expiration. Gamma also changes as the expiration date approaches. It increases as you get closer to expiration for at-the-money options because delta becomes more sensitive during this time. So back to the dancing metaphor. You have the stock price, the leader, and the delta, the partner. In our previous dancing metaphor, delta was the responsiveness of a dance partner to a leader. Now let's introduce gamma to this dance and pretend the dance partner is now delta. Gamma can be thought of as the rate at which the responsiveness of the dance partner delta changes as the stock continues to lead the dance as the stock price changes. So higher gamma means you're adapting more quickly. So a high gamma means the dance partner, the options delta, is quick to adjust its responsiveness. As the stock makes its move, price changes, the option doesn't just follow, it also changes how closely it follows. This is like a dance partner who not only moves with the leader, but also rapidly adjusts their following style based on the leader's movement. Low gamma. This suggests that the dance partner's responsiveness, the delta, is relatively stable. Even as the stock makes new moves, the way the option follows these moves doesn't change much. This is akin to a dance partner who doesn't adjust their dancing style and consistently follows the leader in a similar manner, regardless of how the leader's style evolves throughout the dance. So recall, delta is not linear. How quickly and by how much delta changes varies based on the stock price and the option's strike price. In other words, the relationship between stock price sensitivity, delta, and the stock price is not linear. As the stock price approaches the strike price of a call option, indicated by the gray dashes line at 100, the curve becomes steeper. The steepening near the money reflects an increase in sensitivity, and small changes in the stock price lead to larger changes in the delta. The nonlinear relationship of delta changes to stock price movements is governed by gamma, which measures the rate of change of delta. Key characteristics: gamma is highest for at-the-money options. Gamma is positive and highest when you're at the money. So you can see here, if you had a price underneath here, and this was the price of the stock, then you can see the gamma is going to be highest when you're closest to the price of the stock, or if you get further out of the money, the gamma lowers, or further out of the money, either way, the gamma lowers. Now, a key characteristic, gamma is more significant for options closer to expiration. Let's break it down with an example. So delta and gamma versus price and DTE, days until expiration. Right? Imagine stock ABC is at $100 and you have a call option with a $100 strike price that expires in 1 day. The delta of this call option should be about 0.50, about 50. Since there's theoretically a 50-50 chance of the stock moving in either direction. Let's say the stock prices increases by $1. If there's only 1 day until expiration and the option is now $1 in the money, what's the probability the option will still be at least 1 cent in the money by tomorrow? It's probably pretty high. So the delta will increase accordingly, making a dramatic move from a delta of 50 to a delta of about 90 in this example. Well, what if the stock price decreases by $1? Conversely, if ABC stock drops from 100 to 99 just 1 day before the option expires, the delta might change from, say, 50 to 10, reflecting the much lower probability that the option will finish in the money. So as expiration approaches, changes in the stock value will cause more dramatic changes in delta for near the money options due to increased or decreased probability of finishing in the money. So more dramatic changes equals higher gamma. Now let's pretend we also own a 45 days till expiration call option, the 100 strike. So you can see here what the deltas are, and you compare them from 1 day, 1 DTE, compared to 45 DTE. And you can see still right at the money, they're probably going to be close to 50, but they're dramatically not moving. For example, the 45 DTEs, deltas aren't moving very much when the stock moves. Notice how the delta are less extreme or not closer to 0 when you look at the 45 DTE. They're not closer to 0 when they're out of the money. See? Because there's more than just 1 day until they expire. So the gamma is lower. So higher gamma for short-term at-the-money options. More rapid delta changes equals higher gamma. We know that near the money options with a short time to expiration, short-term options, tend to have a more rapidly changing delta in response to stock price movements compared to longer DTE options. This is because these options are on the brink of moving in or out of the money, making their sensitivity to stock price changes, as measured by delta, more pronounced and volatile. So again, delta and gamma versus price and DTE, you can see the dramatic changes when there's only 1 day left in the gamma, right? You can see how the gamma is much higher than it is at the 45 DTE. So you can see, and the result of the deltas are moving much more in this scenario than they are here. See, the deltas are moving to 32 or 40. This is drastically, from 50 down to 1. This is only 40 because the gamma is also not that significant. So it's not that powerful. Gamma is not as high. It's not as powerful in the longer DTEs. So lower gamma for short-term at-the-money options. So less rapid delta changes equals lower gamma. Longer-term options, even those that are near the money, typically experience less dramatic changes in delta for the same price change in the stock compared to shorter time to expiration short-term options. This is because the additional time until expiration provides a buffer against immediate changes in the stock price, reducing the volatility of the delta. So again, you can see where the gamma is not as prevalent here. So the gamma is not as prevalent here. It's higher because we're closer, even though we're in the same spot. And here you can see the gamma is very low. You can see when you start getting way out of the money, the gamma doesn't really have that significant of a move up. You can see when we get further out of the money, the gamma doesn't move too significantly, but it's when we're at the money, that gamma is very significantly affected by the 1 days until expiration when you compare to something further out in time, like a 45 days. Wrapping it all up, relation to delta, gamma is essentially the acceleration of the options price movement. If delta tells you how much the options price will move, gamma tells you how much delta itself will change with a move in the underlying asset. The stability of delta. Gamma can be used to measure the stability or instability of delta. A higher gamma would indicate a greater potential change in delta, which equates to an instability of delta. Essentially, when utilizing delta for the probability of being in the money at expiration, gamma can help determine the stability of that probability that delta provides. Managing gamma, especially in conjunction with delta, is vital for maintaining control over risk and potential rewards of your option strategies. Gamma and delta hedging. For traders holding options, especially market makers or those with large portfolios, managing gamma is crucial. They often engage in delta hedging, where they adjust their positions to keep the overall delta, and thus the portfolio's directional exposure, neutral. And as the underlying asset price moves, gamma indicates how often and how much they need to adjust to keep that neutrality. Risk management. A high gamma can indicate higher risk and potential for more significant profit or losses. Trades need to be aware of their gamma exposure and how it can affect their positions. In calm markets, gamma might not play a significant role, but in violent markets, it can lead to rapid changes in delta and therefore the options price. Strategic decisions. Understanding gamma helps traders in decision making. For instance, if you expect significant price movements in the underlying asset, you might prefer options with higher gamma to capitalize on the rapid changes in delta. Conversely, if you want to avoid large swings in delta, you might opt for lower gamma positions. We'll see you in the next lesson. My new book, it's out, called All Market Trading Profits. And for those who don't know me, my name is Carl Dahm. and I'm also known as the transparent trader. My marketing guy, he convinced me to write a book that shares my secret trade details with you. It's the same trade I used to make $597,210 in third-party verified profits from 2019 to 2023. I'm not sure how long I'll keep these secrets in my book, so you might want to grab a copy before I change my mind. Don't miss out. In my book, I reveal the unique trade structure I developed, something you won't find anywhere else. The book isn't AI-generated content. It's real organic material. If you're interested in learning the trade that drives over 70% of my net worth, click the link in the description to get the book and see how I achieve my results. The book is $30 on Amazon right now, and I'm offering a downloadable version for only $5. See that link in the description.